Good afternoon. Welcome to the LA County Real Estate Investors Association podcast. I'm Bill Gross, your host. We do this every Tuesday at 3 p.m. We live stream it on YouTube, Facebook, and LinkedIn. And we bring you here resources to help you increase your income and build your wealth. One thing that Lloyd says, who's the leader of our group, is that you need three things to succeed in real estate. One is a coach, mentor, leader. Second is a system, process, or procedures. I'm summarizing a little bit. Third is a community. And this person today, I've met him, had a chance to talk to him previously, really, I think checks all three boxes, is both a coach and mentor and leader. He has a fantastic community. And not only does he have a procedure in methodology, he has not just a book, but I think this is his third book coming out. So let me welcome back to our program, Lane Kawaoka, who is coming to us today from Hawaii. Lane, welcome.
Hey, thanks for having me. Good to see you, man. See you.
Well, great to see you. And so the Wealth Elevator, is the title of your website, it's the title of your podcast, it's the title of your upcoming book. Give me an idea of the synopsis of what is the Wealth Elevator.
Yeah, so it's this financial journey that I kind of went on from, graduating college, buying rental properties, buying 11 of those turnkey rentals, and then moving on to syndications and private placements. And, nobody really talks about this concept of there's paradigm shifts when you kind of get from $1 million net worth to $2 million to $5 million net worth. And that's what I kind of put in the Wealth Elevator book, where there's kind of a map system. There's literally a chart in there that says, hey, if you're between this net worth, this net worth, this net worth, this is what you should be doing in terms of taxes, what your investments should be looking at. Should you be buying rental property? Should you be flipping rental property? Should you just be investing as a passive investor, right? Like those types of items. Because I think there's a lot of education out there, like Rich Dad Poor Dad book, great book, but a lot of it's predicated on people who have yet to hit multi-million-dollar status. So really the emphasis is on higher net worth accredited investors, and then what are the steps beyond.
And so it sounds like in the old days, I'm a little older than you, Lane, you used to go to department stores and there's an elevator with 6 different floors, different products, and each floor had the products appropriate for that group or genre. And so I remember the high-end women's fashion might be on the 4th or 5th floor because not everybody got there, right? But on the first floor was more the everyday kind of stuff that everybody went to. And so is the elevator kind of a similar concept? You got to start at the first floor, right? At some point, you got to make more money than you spend and start reinvesting, and there's different steps for those people than people who are further down the ride. Is that kind of the format?
Yeah, exactly. I mean, we call it the basement floor. I kind of started there. I started kind of beyond there because, in my family growing up, we were taught to be very frugal with our money, never spend more than we make. And I was fortunate enough to go to college, become an engineer, and get paid a pretty nice salary. So I think that's where a lot of people out there are kind of stuck in the basement. And it's, no problem if you're there, right? You just need to recognize that that's where you're at. And you need to start to learn how to budget, not spend more than you make. Or if you are not making $50,000, $60,000 or greater, you need to work on that income side, right? Like how Grant Cardone says, work on the income side and don't really worry about the expenses side. But shortly 2009, I bought my first rental property right out of college. And that was kind of when I first stepped on that first floor of the Wealth Elevator, buying little rental properties, continued to buy rental properties, had 11 of them in 2015. Then I realized, accredited investors don't really buy rental properties because of the high liability and the headache. I think if you're listening now and looking to buy several rental properties and under $2 million net worth, put your earmuffs on, right? But just I think it's good to know what is kind of on the next horizon. And this is kind of where I was in 2015. I had 11 rentals and I was starting to rub shoulders with other accredited investors. And what I realized, a lot of these people were doing things very, very differently than what I was doing, up to that point. Sure, rental properties got me to accredited status, $1 million net worth or greater, but that wasn't what the wealthy people were doing after that. They were, a lot of these strategies were syndications and private placements, and really started to bring in a lot of these tax strategies, real estate professional status, and then infinite banking and accredited investor banking, which we kind of set up for people.
Very nice. And so the website Wealth Elevator, over $2.1 billion of real estate owned. Wow, what does that look like? What's the product mix? What's the geography of the property in the wealth elevator today?
Yeah, I mean, we haven't picked up properties in the last year, but you know, we when
Get
we kind of
ready.
started out 2017, we would pick up these little small Class C multifamily properties and turn them around, and then we kind of stepped up to more larger Class B. Today, we start to bring in developments into place and brand new builds. But yeah, you know, out of our investor group, we've raised over $200 million from our little cohort. Um,
Nice.
put on some great parties. We're gonna be in Las Vegas this next month for our annual retreat. But it's a group of accredited investors kind of investing alongside of each other. I think it's about 10,000 units, but I think overall it's like 60, 70 projects or so. You know, whether that's a smaller apartment building, bigger apartment building, or development. You know, that's kind of how that's how many projects we've kind of done thus far.
So this is not just the um, want to get started. I want to become an investment guru. This is you're actually doing this. You have a kind of a tribe of people or a community of people that you've brought along with you and are participating with you at a pretty high level. It sounds like.
Yeah, I mean, I think there's a lot of marketers out there that kind of teach this type of stuff, but you know, we kind of focus on doing the thing, operating the assets. And then I think the passion project of mine is the Wealth Elevator project, which is kind of the holistic financial planning, which is three main things: deals, right? These types of syndicated projects where you get slightly higher alpha, but from these projects, this is where you unlock the tax benefits, the depreciation, the passive activity losses to really start to bring in all these tax strategies. I mean, a lot of our clients are able to save $50, $100,000 their first year in taxes alone. And
The
then,
first time I did a limited partnership and closed in December, and I think I put 50,000 in, and I got a write off of like $41,000 that year. And it was like you always wonder before you get your return for your money, even no matter how much you vet them, you always wonder, am I really going to see the return? Am I really going to get my money back? And I got that write off right away. It was like, wow, this is a great system. I mean, I need more of
yeah,
this.
yeah. I mean, when I had rental properties, or I'm sure all your listeners know, like you can write off the asset price over 27 years, 127 a year. So but with these larger syndication deals, we can do what's called a cost segregation. Basically, we pay like 5, 10 grand for a CPA to come in and do a bunch of reports. But we take that report and we're able to extract not 127 over 27 years of depreciation, but a lot of times in that first year, take 1/3 of the property value as a loss. And that's kind of where, your big first year loss came from. And you're gonna have to recapture that at the end, of course, right?
Right.
But the whole point of this is to be very time efficient with your deductions and taxes. So I think in your case, if you got $40,000 of losses and you were able to at 40 cents on the dollar to, get a deduction for that, you could have saved well like 15, 20 grand
Right.
right there to
Like
maybe
that.
go put into a deal 2 months from now, the next year, right? I mean, that's the time value of money or time efficient use of money. And I think that's just I wasn't aware of this. Like I knew like real estate, rental properties were great sources of, tax benefits, and they are, but man, do they get juiced when you get into the syndication and
Right.
private placement world.
I think it did two things for me. One was, I mean, obviously getting money up front is always good, even though it's going to get recaptured. Like I said, I got some return for my participation right away. And you always want to minimize your risk. So even if the deal fell apart, I got some benefit back. Second, in my case, like a lot of people, I'm still making good money. I'm going to retire at some point and I'll make less income in a few years. My plan was I'm investing in these things now and they're going to be maybe selling out. I'll get a distribution 3, 5 years from now when I have lower income. I maybe not that quick, but whatever. That would be ideal, right? I make money now, put the money in, get the accelerated depreciation, and then maybe I stop earning a lot 5 years from now, and 7 years from now I get a big distribution. I'm at a lower tax rate. So that's the other part is that recapture comes at the end, and so it really shifted some of the income, and it also minimize some of the risk that I just didn't appreciate in the short run how much of an effect and how powerful that can be. That I did take some money and put right back in another deal because why not? I have more cash and I don't want to spend it. I mean, I could go buy nicer things and nicer cars, but I really not. I'd much rather count my money than spend on frivolous things, at least in my lifetime. And we do a lot of good stuff with what we do. So okay, so that is the model then of people investing with you. Mostly, they're coming as limited partners, and you're bringing deals to the market and offering other people invest along with you.
Yeah, that's correct. I mean, I think in 2020 we kind of got off of a level of, we started to hire other people that kind of were professionals in their own right, people who were better than we were as operators. And, essentially we emulate what the large private equity companies do, that are kind of running the big money out there. But what's cool is you're able to cut out all the middlemen, and you're able to get directly with the operator. And you know I think a lot of people are aware of like the crowdfunding websites out there. What they don't realize is a lot of those websites are just broker dealers. They're just a middleman,
Right,
right? The operator is paying them money to put their deal on their website, and they're taking a cut.
right,
Ultimately, that comes out of the passive investors
right,
bucket. So, and again, this is something that was totally new to me, back in 2015, that there's all these smaller investors running around looking for direct to operator type of deals, right? To get the better returns. And some of these guys, they like to build relationships, right? With the people that they're giving their money to.
You talk about the Wall Companies. I have to tell you, as a listing agent in my market, I don't do a lot of non-residential, but I do a good amount. I make a good living at it, commercial and retail and industrial. It's interesting how I always found they always overpaid. Like, in a competitive market, you get multiple offers, and they're the ones who I think right now in our market have a lot of more inventory than they know what to do with, and it's gotten harder to develop. It's gotten harder to do the value add they planned on, and some of them are starting to offload some of the inventory. So you have to be careful who you do business with. Just because they have a fancy website and a lot of numbers doesn't mean it's a good place to put your money. And I think that's the part of your program that I found appealing, was that you really are out there sharing what you do. So just before going any further, so on the website, if you're interested in keeping up, there's a couple ways. He has a podcast. He also has a book coming out. And so if you're interested with the Wealth Elevator book notification, I just filled this out. But you can stay in touch with him as he launches his book coming out. You said in January, or when's it come out?
I think it's gonna be around Christmas time, is my guess. What
That's
they've
pretty
told
close,
me.
man.
Yeah, pretty
I don't know about you,
close.
but
Yeah.
I think Santa's charging up the sleigh right now as we're talking. So I'm Jewish. I don't really know, but I think that's how it works. So,
Yeah. You're
so
probably right. You're probably right.
along the way, you also have a podcast, The Wealth Elevator. Talk about that a little bit. And what's your goal there? And again, if you're watching on the show, feel free to check it out and subscribe to it and pay attention. I do, and it's some great material. What do you find a value for putting on the podcast, and what should people find a value when they work with you?
Yeah, I mean, the podcast was actually what we started first in 2016. But back then it was more of a follow my journey type of podcast.
Welcome,
Back then,
folks. This next president.
I was still buying little rental properties, and at that time, sort of making the transition to larger syndications and private placements. So a lot of those earlier podcasts, I think we have like 400 podcasts now. We're kind of surrounded around that, but I think that's where like investors, they give me feedback, and I think that's been the feedback that I've gotten. They like it because we kind of tell it how it is. I'm pretty transparent, good and bad things, and what's kind of going on in the market. And you don't, there's like, for example, I think we were kind of mentioning this earlier. When you get in off the beaten path of syndications and private placements, it is a bit of the wild wild west out there. I mean, my first several, I mean, on a few occasions in my first dozen deals, I invested with either a shyster or somebody who just playing the fake it to the make it game. A lot
Wow.
better at taking selfies and putting a website together than operating the asset.
Wow.
So that's kind of how it is in this type of world. Some investors can mitigate that by investing with operators with several $billion of assets. However, your fees and splits aren't going to be as good, and you're
Correct.
not going to maybe double your money in 5 years. You might double your money in 10.
Right.
I always tell my folks, well, try and find somebody at least $1 billion of assets under ownership or greater. That seems to be about, at least for us, that was the mark when we kind of started to hire out the team and build out the team there.
I like that. I know when I started, I invested some money with Grant Cardone, knowing there's a higher, he's taking a higher margin. I'm going to make a little bit less, but he's also an educator. And so part of why, I've always wanted to work with different people the first time is to learn from them as well as to know who they are. And I think I think both of those are important. I'm in the business, so for me, if I don't know who you are, I can find out pretty quick who you are because I have access to a lot of those resources. But I would recommend anybody investing in the beginning, take a look at your first investments, I think, as somebody who's going to teach you along the way, because you're going to learn. You're not going to get rich on your first $25,000 or $50,000 investment. You're going to get rich by building a relationship and over time adding to your nest egg and reinvesting and adding to the nest egg and reinvesting. And that takes several relationships, I think, to get there. I know that's been true for me.
Yeah.
So,
yeah.
What do you? So that's the website. I'm sorry, the YouTube channel, the Wealth Elevator as well. So, very active and a lot of good education there. And I also really feel it's important that when people give you information for free and are transparent, they're the kind of people you do business with. If they're not, when you research companies is all kind of hidden and off behind some paywall, and the videos are all Vimeo where you can't see the view count. There's a reason why they're not sharing their information. Usually they're not walking the walk, or there's something to it. And I really applaud and appreciate you demonstrating yourself to the market and that being really leading, I think, from that point of view. So obviously in the last week, we had some pretty dramatic news. I think the rate drop was the largest 2-day rate drop in the last 30 or 40 years. For the last months, the story has been the rising rates are like a vice that are going to continue to squeeze some of these poor operators and force them to sell at losses and things fall apart. Is this rate change going to be a significant reprieve, a partial reprieve? Are those operators who are in trouble still in trouble? What do you see the effect of this latest change in interest rates?
Well, I mean, the Fed isn't dropping rates right away. I mean, what I would recommend people do if they really want to see what sort of the Vegas odds are the rates dropping, you need to go to the Chatham Financial website. There's a curve on there that they use to predict the rate drops, but it's not coming down anytime soon. And there's definitely this narrative put out by, sorry, Bill, but mortgage brokers and realtors wanting to get people to buy houses, right? The reality is like, even if the Fed starts to drop rates a quarter point every single time in 2024, the Fed rate is still going to be in the 4% range, pretty dang high still. Right. So I don't see that really coming. Everybody says that the rates are going to be dropping down. It's not going to be anytime soon. At least a couple.
I don't see how. I don't see how. If the fundamentals that caused rates to go up was an increase in printed money in circulation, divided by people. The only factor I've been thinking about this. I haven't seen anybody talk about it. I'm just curious as your thought. My own theory and process. If I was in control of the government today, if I was running for re-election, it'd be very important to me to try to lower rates. So you try to complain and you demonize the bankers and you blame the rates, and that's called job boning. That's been around forever, but you can only do so much with that. But I do think that the immigration might be part of the strategy of deflation, in that if you bring in a bunch of people with no money, then the money you have is spread amongst the people who are there in the population. Perhaps that's a way to, I haven't ever seen anybody, we've never had immigration at this level. So I don't know that we know what the economic effect might be. But absent that, there's nothing happening that would cause rates to go down significantly, right? The factors that cause it to go up are still there. So why would you think rates are going to go down? And so to me, I was shocked at the drop, like a lot of people. But to say it's going to continue to go down over the next year, I mean, it would be fun, but I don't know that I can't imagine how it happens.
Yeah, I mean, again, the best case scenario is they drop a quarter point every single meeting,
Right.
but you're still in the 4% range. What's more
Right.
likely to happen is a quarter point here, maybe a half a point there, but and maybe another quarter point, like a few of these drops,
Right.
and that's more likely, and that's
Right.
not kind of really impacting too much. The narrative that you're saying of like the election coming up and influencing that, I think that is the one saving grace to maybe see some kind of stimulus or lowering of the rates quicker. But again, the other side of the coin is, we went through this before with Volcker. Volcker had the double inflation hit, and I think that's what is going to happen here. We're going to see inflation come down to the threes, maybe kiss the 2% range. But I mean, I really do see it coming right back up to 5, 6+%. And then and I think the Fed knows that, and they can't have another Volcker incident. And that's why they're going to be very, 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 very cautious in lowering the rates, even if some political party is yelling and screaming at them.
Yeah, it feels baked in. Like there's not much fundamentals they can do. So based on that, where do you see the real estate market? Now, I'll say personally, of all the markets, residential has performed the best in last year. I saw a chart and I shared it on my podcast where residential values were, when I say residential, single family homes primarily where we operate as agents, was basically flat to, plus 2, 3, 4, 5% of the last 12 months or so. Whereas commercial dropped, retail dropped, industrial dropped overall nationally, not in every market. So really, in some regards, residential has held up pretty well. The number of sales is down because of some of the inefficiencies, but the value of the houses has stayed the same or gone up almost universally. Where do you see the real estate market in multifamily and the types of markets you're investing in? Where do you see the economy? Is it, the economy suffering and it's opportunistic for you? Is it the economy is going to be growing in a healthy way and you're taking advantage of it? Where do you see the market headed?
Well, the residential and commercial is two very different worlds. I mean, residential supply and demand. I mean, it kind of reigns supreme right now. There's not a lot of people moving from their houses because they're kind of
Right.
stuck there with their great 3% loans. So that's the reason why that there's low supply, and thus the prices didn't take a nosedive. In the commercial world, it's a very different story. Prices came down maybe 20 to 40% at least. And that's caused by cap rates going from a 4 to 6%. Because in commercial real estate, the price of the property is dictated by the net operating income divided by the cap rate, right? So the cap rate is in that denominator portion. So if that cap rate increases from 4 to 6, your price of your property magically drops, unfortunately. So I think what you're going to see with the commercial properties too is like the loans. A lot of these loans are with 2 year, 3 year, sub 5 year notes. Very common in commercial real estate,
Yep.
where residential real estate's done with 30-year AMs, and therefore you can just kind of hold forever on that stuff essentially. So, I think all asset classes are impacted. Office is obviously, I think, the worst one, then multifamily apartments, industrial, mobile home park, self-storage are impacted a little bit less. But the commercial real estate world is, impacted very greatly by these interest rate increases.
Right. And so, for you as an investor, I was listening to Grant Cardone had a conference call last week where he was saying he thought this was the opportunity of a lifetime. That if you have capital, if you watch your expenses and have extra money to invest, there'll be investors who have these deals they can't refinance, and there'll be the opportunity to control assets that cash flow at the new price if you're able to get in on the deal. Not that doesn't mean every deal is going to. Obviously, you have to pick through and find the right deals. But I think he's right on. I think there's the opportunity of a lifetime if you're smart and have capital to get better returns and lock in long-term benefit. Do you see it like that? Do you see it different? Where do you see the market that's coming up for us next year? The opportunities or the concerns that you have?
I mean, he's right on the fact that like prices are down 20%, 40%. Where he's wrong is, all right, to buy these properties, you need to put a loan on it. And where interest rates are at, more importantly, where the loan proceeds are at, where the the loan to values are at. Before I could get a loan for 70% of a building. Now it's like 50%. So to bring a lot more to the table.
Right.
So even if the price of the property is a lot less, 20 to 40% less, I in some cases I got to bring more money to the table, right?
Right.
Because of less loan proceeds.
Right.
And at the end of the day, it's just a spreadsheet exercise. A lot of the time, and this is why we haven't been doing deals this past year, because the numbers just don't pencil because I have to bring so much capital to the table.
Right.
Instead of maybe $8 million, I got to bring 12 now, even if I'm buying the property at a lot less price. So I think again, Uncle G is placating to folks out there that aren't really in the game, and what he's saying makes a lot of sense. But in reality, like I don't see the opportunity to buy anything until maybe 2025.
Well, I think the difference is, if I not to argue with you, because really you're well more advanced in this area, but maybe I know a little bit more about him than you do, because I've studied with him and known him and whatever. But I think the difference might be he obviously has the ability to raise a lot more capital because of his rise in popularity. So where you're saying you have to bring more capital in, my guess is he has capital coming in and has a system, and that's an easier skill or easier result for him to create, and that more of his investors are not sophisticated, as focused on the rate of return, because what they're otherwise getting right now, like me, is bank rates, stock markets, investments, that traditionally have not done well, as well as not provide the tax advantages. So by bringing people into that world, they're maybe selling for a lower rate than a professional real estate investor already might, but it's better than what they got in their 401ks and stock funds on an after-tax basis, so much that number makes sense. And so I just think maybe he's maybe talking, and I think that's the audience to
Yeah,
talk
no,
to today.
you're probably right. I mean, he is a great marketer, and he's able to kind of sandbag his returns to investors because the investors just aren't really super sophisticated, like how you say it. But still, I mean, if investors are looking for a certain ROI return,
Right.
then if you're bringing so much money to the table, regardless if you can raise it very easily, it's still just like a math equation of our return
Right.
on investment. And it's just hard with like you having to bring 50 cents on every dollar for a down payment, as opposed to used to be you could bring 30 cents on the dollar as a down payment.
I think he's able to be attracted to a customer that you wouldn't, that will settle for less and start. And I'm thinking that those people, and I'm one of them, who's now grown up a bit, a few years later, and I'm now looking and branching out from other investments with a little more, some success under my belt, not just from him, but other ones I've done. But whereas 10 years ago, I was frustrated and content with no real estate investments. It's also an education process, and that's why I think you leading with education is so important, because I do think there are investors out. There's more need for investors to take money that's sitting in the bank and getting destroyed by inflation, and there's more money from investors that are in assets, stocks and bonds, that they're being clipped and cheated every day. I think his take on that industry is right on, spot on. People are more concerned about politics than they are the rate of return to their customers. And I think that the more that you can, for example, with your book and your YouTube channel and your program overall, can help people learn to make that bridge themselves. And I think Grant does that really well. And I think you do some of it. I think that's the opportunity. At least that's what I see as opportunity in our market, that there's people who really need, because if you don't take advantage of this and you don't provide for your own finances, the government's not going to. I mean, they're just, I'll never forget. I'm older than you, Lane. So when 65 is like a magic time for health insurance. I paid health insurance for my wife's a little older than me. So when she became 65, it was like, boom, this huge expense went off our table because the government's picking up a lot of it, and you pay for supplements and stuff like that. But it's a big savings. So I become 65 next month. So I'm enjoying that part. Social Security, somebody said to me, well, get whatever you can now, opt in early rather than wait till the full retirement, because it may not be there a few years from now. I said, well, that makes sense. I don't need the money. I'll just take it, invest it, and whatever. I'll do something with it. So I went through the process, and the Social Security said I was too rich to get my own money. I'm like, what the hell is my money? What do you mean? What do you mean I'm too rich? I don't feel that. I mean, I'm very blessed. Don't get me wrong. It's my money. What do you mean I'm too rich to get my own money back? So if you wait on the government or your company or your pension or 401k, it's the wrong place. You really need to find a way to be a student of this information, and books and seminars and programs and YouTube channels, and Lane's somebody who is a little more sophisticated on the food chain from Grant Cardone, I think, up the ladder to what you're doing with Wealth Elevator. I just really admire what you're working on, and really want all the people in our channel, when appropriate, to take a look at that step up. Okay, so let's go back a little bit, because you have the book. You're obviously reaching out to new people. When you started and were doing rentals before you invested with somebody else, because there's a certain mindset of the rental investor is control. That's a pretty common experience for me as an agent. For you to write a check to somebody else for whatever it was, $25,000, $50,000 or more, what was it that allowed you to make that leap? And I know you see customers or prospects that talk to you and just can't make that decision and get started. What was it in you that helped you make that jump, and that you wish other people would consider as well to make that jump for themselves?
Yeah, I mean, I was in the pain a little bit. Like, I had 11 rentals in 2015, and sure, I had, professional property management to do all the dirty work, right, and fix stuff. But maybe I had an eviction or two every single year, some kind of big catastrophe that happened every quarter. And then, just managing the manager, babysitting the manager, it started to realize that it was becoming another job, and it just also wasn't very profitable too. So, I think a lot of us investors that live in, places that are remote to these rental properties, for example, you live in California, but you got a property in Illinois. All these property managers just abuse you and know that you're just some rich guy out there. Like, you got too much money, no Social Security for you. And like, that was the point. I was just like, man, this sucks, right? Like, there's no alignment with my property manager. They're just making out and like giving the work to their buddy at a higher price. They don't really bid it out, they don't give it the same care I do. And then again, it came up from another side too, right? As I started to interact with these higher net worth investors, they were all kind of opening my eyes to the liability of these rental properties, as opposed to the limited partner position, the LP position. And I just started to see, like, people I respected who had more money than me were all selling their rental properties and transitioning to more of these syndicated private placements over the time. And that's kind of what we talk about in the Wealth Elevator book, this transition. And most people will start off with 10-20% of their net worth over the first few years, get comfortable with the people that they work with. Hopefully they don't kiss some frogs. But that's kind of where I think what helped me, and what we try and create for our folks, is like a community of other passive investors.
Mm-hmm.
These aren't the guys who are non-accredited. These are the guys who actually invest in this stuff, and then you start to build like real life accounts of who's legit out there, who's just faking it till they make it. And I think what people realize, or what I've realized, is like, it's a very small world of people out there doing this type of stuff, that if you ingrain yourself, you play nice with some people, and you network well, it's pretty easy to figure out where to invest and with whom to invest your money.
Yeah, the whom part. I think that's, in business, one of the things, there's a great book, Who Not How, which is in the concept of businesses, instead of learning how to do things, you want to figure out who can do it for you, so you can leverage your time and do the things you're best at. And, I know for me, rental property was never my path. There's nothing like better than once a quarter. I don't know about you, my deposits go to my bank sends me an email when I get deposits. There's nothing better in the world than an email that says you just got a deposit from some investment that you kind of weren't paying attention to this month and shows up on time or something, which is the best. So That's the beauty of limited partnerships. Well, Lane, I really appreciate you kind of describing the elevator. I look forward to reading the process in the book when you get it published and released. Continue to watch you on your YouTube channel. So again, just a quick recap. This is the LA County Real Estate Investors Association weekly podcast. We do this every Tuesday at 3 p.m. And then we have a live meeting in West Los Angeles every second Thursday of the month. It's free in the Palms area at the Iman Center. Go to lareic.com. You can get the details to show up for the free event. It's usually 6:30 on Thursdays. We have a speaker, different topics. Investing real estate out of state is a very common topic. Our guest today, Lane, is the proprietor, founder, I guess, of the Wealth Elevator, as well as the author of the upcoming book, The Wealth Elevator. And so you can go to thewealthelevator.com and get the book or see his program, learn about what they do and the other programs, including his podcast. And then my favorite channel is on YouTube, which is his podcast, his video input there as well. So Lane, again, it's always a pleasure to chat with you. I always learn a lot. Look forward to seeing your book coming up here soon. And thanks for sharing time with us today.
Thanks, Bill, for having me. See you next year.
We'll talk soon. Thanks so much.